So many traders out there are obsessed with indicators. RSI, MACD, or moving averages. But here's the truth, if you rely on them without understanding the language of the chart, they can actually backfire. See, every candle you see on a chart tells a story, and if you can't read that story, no strategy or indicator is going to save you. Your portfolio is going to end up red. Take this structure as an example. Price moves up, forms a base, and I draw a support line, and suddenly, candles break below it and start dropping. Why did this happen? Well, that is a chart reversal pattern. And in today's episode, I'm going to show you 4 powerful chart reversal patterns you can spot on any market, forex, stocks, or crypto. They can be seen on any time frame, from 1-minute charts all the way up to daily. And to top it all off, I'll use Fibonacci Retracement to show you exactly how to find high probability entry and exit points. So make sure you watch till the end. This one's going to level up your chart reading skills big time. Alright, imagine this. Candles start moving up sharply, and after a strong push, they get exhausted and form 2 identical tops, standing side by side. Now I draw a support line right at the base. Once a breakout happens, followed by a pullback, that is often a potential reversal signal. And from that exact point, candles start moving down, a reversal takes place. This formation is what we call a double top pattern. Let's take a look at this example on gold, 15-minute time frame. You can clearly see those 2 tops standing together. Once you draw a support line for that base, also known as neckline, watch what happens after the breakout. Candles drop, reversing the trend beautifully. No indicators, no fancy tools, just pure price action. Imagine candles dropping sharply, and when they lose momentum, the chart forms 2 identical bottoms, standing together. Price fails to go any lower. I draw a resistance level. Once a breakout and a pullback occur, that is your potential reversal signal. This time, pushing the price upward. This pattern is known as double bottom. On Bitcoin, 15-minute time frame, you can clearly see a double bottom forming, 2 lows side by side. Draw your neckline, wait for the breakout, and watch what happens next. Now you know how to identify double tops or bottoms. Let's take a step further. I'm going to show you how to get high probability entry and exit points using the famous Fibonacci Retracement tool. To add Fibonacci, head over to your tools on TradingView and select Fibonacci Retracement. Click and drag all the way down and to the right, that's it. Now the default settings might look a bit messy, so let's customize it. Uncheck all the values and add -0.27, 1.618 and 2.27. That's all you really need for now. You can always add more later, but this setup works perfectly for what we're doing. Now let's apply Fibonacci to our double top to see how it works. You have to notice something important. The right top shouldn't be higher than the left one. I have found these setups tend to perform better. Now I identified a neckline. Here is how to apply Fibonacci correctly. The first click should be at the beginning of the move that ended at the right top. But the second click should be right at the end of the right top. But here's the key. Instead of ending Fibonacci as 0, place the end at -0.27. This is different from the old Fibonacci setups and gives more accurate targets. Once candles break below the neckline, that is your potential trade setup. Each Fibonacci level becomes a potential target zone, whenever the price hits the first target, I usually move my stop loss to my entry point. That is called going break-even, and then I look for lower targets. Alright, now let's flip the situation. This time, candles form two identical bottoms. Ideally, the right bottom shouldn't be lower than the left one. From my experience, these setups actually perform better. So the perfect condition is when the both bottoms stand close together, having almost the same low. So I draw a neckline, which acts as a resistance level. When it comes to Fibonacci retracement, the first click of Fibonacci should be at the beginning of the move that created the right bottom. The second click should be exactly at the low of the right bottom. That low must align with minus 0.27. Now, since in this example the breakout candle is quite large, I could look for a possible entry, starting from the 1.618 level, and then aim for higher Fibonacci levels. To extend our targets, we can add values 3.27, 4.27, and also 5.27 to potentially catch each rally that the market forms. Now let's move on to our third chart pattern, one of the most powerful and commonly seen formations in almost every market and time frame. Look at this structure. In this chart, you can see a left shoulder, a head, and a right shoulder. I can draw a neckline right below it. And once a breakout happens, it often signals a potential reversal. This is the head and shoulders pattern. Knowing all this, let's check an example on Ethereum, 15-minute time frame. You can clearly see a left shoulder, a head, and a right shoulder. I have identified the neckline, which here acts as a support level. Now notice something interesting. The movement towards the right shoulder is quite weak. This tells us that the market doesn't have enough momentum to push price higher, which means a reversal could be forming. Overall, this pattern shows trend weakness. So when the breakout and a pullback occur, it could serve as a short opportunity, again, based on the structure and Fibonacci confirmation. Now let's flip it again, the opposite scenario. Take a look at this formation. It has a left shoulder, a head, and a right shoulder, but this time the pattern is inverted. It is an inverted head and shoulders pattern. I draw a resistance level, which serves as the neckline, and once a breakout happens above it, that could signal a potential bullish reversal. We are looking at Atom on 4-hour time frame. Here we have a clear inverted head and shoulders pattern. The neckline in this case is slightly inclined upwards, following the pattern's slope. It is in fact a trend line. To apply Fibonacci here, the first click should be at the beginning of the shoulder. The second click goes at the end of the shoulder. Now when the candles break through the neckline, that is your potential reversal signal. From there, we can use Fibonacci levels as target zones. You can even extend them, adding 6.27 or more to capture extended moves as long as the momentum continues. In this final example, there is actually a large head and shoulders pattern on the chart, and inside it, there's this smaller one we just analyzed. So you've just learned 2 layers of structure in one setup. Now we have seen how these patterns actually work. To make these setups even more reliable, we can add an indicator to confirm our structures. Go to the Indicators tab on your TradingView and type in Relative Strength Index, or the famous RSI. Click on it, and it will appear right below your chart in its default form, and no special modifications are needed. This simple tool can really help in identifying high probability reversal signals. Here's what I do. I spot a head and shoulders pattern on the chart and draw the neckline. Obviously, from the left shoulder to the head, the candles make a higher high. But if you check the RSI, it is making a lower high at the same time. This is what we call as divergence. Divergence is an early warning that a reversal could be coming, and it confirms our head and shoulders setup. Then I apply Fibonacci on the right shoulder, and once the breakout happens, that serves as my cue for a potential short trade. Now let's look at the double bottom. Even if the right bottom is slightly lower than the left, that is okay, because we now have an RSI to confirm for a possible reversal. The candles are making lower lows, but the RSI is making a higher low. This divergence gives us a clue that a reversal may be coming, confirming the double bottom pattern. So today, you've learned something valuable. This is only a fraction of reading the language of the chart. But remember, no strategy is perfect. Risk management is always more important than any setup. And I need to be clear, I am not a financial advisor, and this is not a financial advice. All content, information, and opinions in this video are for educational and entertainment purposes only.